Should you buy gold now? Welcome back to the channel, investors. The price of gold is surging, breaking record highs, and every financial headline is screaming about the safe haven asset. But the big question on everyone's mind is this: is it too late to buy gold? Should you be piling into this precious metal right now? We're going to dive deep, look at the major factors driving gold prices today, analyze the risk-reward ratio, and most importantly, give you a simple framework to decide if gold deserves a spot in your portfolio. Gold isn't moving on coincidence. It's being driven by three powerful, interconnected engines. First, and perhaps most potent, is global geopolitical instability. When the world feels uncertain, be it due to wars, trade disputes, or political unrest, investors run for cover. And for centuries, the ultimate cover has been gold. It is a non-fiat asset, meaning its value isn't tied to any single government or currency. This flight to safety is creating relentless, sustained demand. The second engine is perhaps the most overlooked: central bank demand. Nations, particularly emerging economies, are aggressively diversifying their reserves away from the US dollar. Countries like China and India have been net buyers for months, setting new records for central bank gold accumulation. This is governments voting with their balance sheets, solidifying gold's role as a global reserve asset. Finally, we have the classic gold narrative, the hedge against inflation and currency devaluation. While inflation has cooled slightly, the sheer amount of money printed globally over the past few years means many investors see gold as the last line of defense against the erosion of their purchasing power. To properly analyze gold, we must look at its two most important inverse relationships: the US dollar and interest rates. Gold and the US dollar generally have an inverse relationship. A weaker dollar makes gold instantly cheaper for international buyers, increasing demand and pushing the price up. With many analysts predicting a peak in the dollar's strength, this presents a tailwind for gold. The other key driver is interest rates. Gold is a non-yielding asset. When interest rates are high, bonds and savings accounts become more attractive, reducing the appeal of gold. However, as central banks around the world begin to signal a potential end to rate hikes, the opportunity cost of holding gold decreases, making it more attractive to savvy investors. Okay, so the fundamentals are strong, but what about the risk? The primary risk is a global economic soft landing. If inflation drops faster than expected and world stability returns suddenly, the fear premium baked into the gold price could evaporate, leading to a quick correction. Don't ignore this risk. The upside, however, is substantial. Many experts believe that gold has a clear path to reach new psychological milestones due to central bank buying and sustained geopolitical tensions. Gold is behaving less like an inflation hedge and more like a de-dollarization play, which is a powerful long-term secular trend. If you decide gold is right for you, there are three main ways to get exposure. Physical bullion, the purist's approach but costly storage. Gold ETFs, the easiest and most liquid way. And gold mining stocks, a leveraged bet, higher risk, higher potential reward. So, should you buy gold now? Gold is not a get-rich-quick asset. It is an insurance policy. Given the current global uncertainty and the aggressive buying by central banks, a small, strategic allocation to gold, around 5% to 10% of your total portfolio, is a highly prudent risk management move. If you believe the world will become more stable, less inflationary, and that the US dollar will remain unchallenged, then maybe gold isn't for you. But if you see the current trends persisting, gold is a necessary foundation for preserving wealth. What are your thoughts? Are you buying, selling, or holding gold? Let me know in the comments below. Don't forget to like this video and subscribe for more deep dives into the markets. We'll see you in the next one.